They wanted, how much did they want? What was the goal?
$40,000.
$40,000 of income. But their portfolio, like a lot of portfolios today, because interest rates are low, was only generating 15. So they want 40, they're getting 15. But the 15 that they're getting in income, 10,000 of that's going where?
To the advisor.
To the advisor. So what do they have left?
Five.
There's
an even bigger gap now.
5,000. So they're short $35,000.
Welcome to Retirement Today. I'm your co-host, Zach Holcomb, and alongside me we have Michael Reese. He's a certified financial planning professional and retirement planning specialist who spent the last 25 years helping families get into and through retirement. It's Michael Reese. Mike, super happy to have you back with me on the show this evening. But before we dive into the show tonight, how are you today?
I'm doing great, as always. Love living in Austin, Texas. And I'm excited about tonight's show. Because,
yeah, me too.
You know, I know we are going to be talking about this thing called, what is it called now? The Great
Resignation.
Yes, the Great Resignation. So we're going to talk about that. And we're going to talk about, really the three things you have to get right when it comes to your retirement planning. This is really important now because you gave me some statistics before the show. I was blown away by these statistics.
So this information, the source is from the Pew Research Center. So they've done these studies. They've gathered the data. So by the third quarter of this year, in 2021, about 50% of U.S. adults, 55 and older, they're retired. They've left the workforce for good.
For the population above the age of 55. Half of them are out of the workforce.
Yeah, and that's a crazy number to think about because 55, that's still relatively young. When I generally think retirement, I'm thinking like, mid-60s or later. That's conventional thinking.
My wife says that I am not going to be able to retire. She is going to make me work forever because she said, if I have to deal with you being home all day, you're going to drive me crazy. That's what she says to me.
Thanks, Becky.
So you guys got to put up with me for a while. And what was that other? There's another statistic, something about how like the average, what was it? The average number of people who retire each year is like 1 million people.
Yeah, from 08 to 2019, everybody over the age of 55, it's growing by about 1 million a year. The people retiring.
Okay, so between 2009 or 2008?
Yeah, 2008 and 2019.
2008 to 2019.
Yep.
That group, people over the age of 55, about 1 million of them would retire each year.
Yep.
That's what it was, and then COVID hit.
Yep, the last 2 years, instead of 1 million per year, 3.5 million.
Wow. So 3.5 times the number of people that normally retire are retiring.
Yep.
In that age group.
Yep.
All these people are retiring. Are they making the right decisions here financially?
Right.
What's your favorite phrase again?
An investment plan is not a retirement plan.
An investment plan is not a retirement plan. And, I want to share this story. Let's call them Bob and Susie, not their real names.
Names change to protect the innocent.
Names have changed to protect the innocent. Thank you, Jack. I think Jack Webb would say that. And you don't even know who that is, right?
No idea.
Anyway, this couple, they were listening to the radio show, kind of like what you're doing right now. And I don't know what we were talking about the day they were listening, but I know they had called in because they said, man, we need a second opinion. Something we said resonated with them, and they said, we just need a second opinion. So they came in, and I actually talked to them. In our office, we have, we have a whole team of people that help all of our radio listeners that call in, and that's fine, right? But for whatever reason, I happened to draw the straw, and they talked to me. And they actually said, that's what they said to me. They said, Mike, I said, the first thing I always ask, how can I be helpful? What brings you in to talk to me today? They said, Mike, we were listening to you guys on the radio, and they couldn't even remember, Zach, what we were talking about. Mm-hmm. All they remembered was, he said, I don't remember what you're talking about. We just felt like we needed a second opinion.
Yep.
And, like they said, you can't get a second opinion from the person that gave you the first opinion, right? So in any event, they said, we're getting ready to retire. We want to retire here at the end of the year. They were part of this over 55 group. Mm-hmm. And they just wanted to make sure that they had all their planning ducks in a row. They wanted to make sure they're dotting their I's, crossing their T's, that they hadn't missed anything. And when we sat down with them, I said, well, tell me, what's going on now? Well, they had this advisor that they're working with for the past 15 plus years. Really good person, a good guy. They liked him a lot. He worked at one of these big firms, you see him all over the place.
Sure.
And I said, okay, well, tell me a little bit about what he's recommending for you with your retirement. I'm sure you've told him you're retiring. What's he recommending?
Yeah, what's the plan?
What's the plan?
Yeah.
They said, well, that kind of is what brings us in here. Because, when we visit with him, the way it works is, he shares here's our investment portfolio, here's how we're doing.
Yeah, here's your returns, year to date. Yeah, here's your numbers.
Right, here's your numbers. Here's how you're doing. Here's how you're earning. Hey, we're earning a lot of money, right? That's great. But the question, then we asked him, well, we're getting ready to retire. How are we going to generate income? And his comment to us, this is what they said. So this was a quote. The quote was, his comment was, and oh my gosh, I said it's a quote. Now if I don't get the words exactly right, I'm probably falling into some kind of compliance quagmire. So essentially what they said, let's not say quote. Essentially what they said was, they said, well, he says, don't worry about it. You're good. I'm like, what do you mean you're good? He said, well, that's what we said. We're good. He said, you've got enough money. You don't have to worry about anything. We're just going to we're just going to scrape off your income. It's not a big deal. And that's about where he left it. And so then I said, well, okay, what about, income? Okay, what about your Social Security? Did he give you some ideas of when you should take that? No, not really. Okay, what about your taxes? Did he talk about how you're going to manage, in this case, these people had over $1 million in IRAs. Mm-hmm. How are you going to manage all the taxes that you're going to have to pay on those IRAs? Should you be doing Roth conversions or not right now? What was his thought? Did he give you some thoughts on that?
No, they don't do taxes.
Yeah,
so.
Again, that wasn't we don't really know. And they said, that's why we're here. We don't we're not getting these answers. I said, okay, what about some of the risks out there? What if the market earns nothing for the next 10 years? Are you still going to be okay? What if inflation goes crazy? What if we want to live a long time? What if you die? What if you die too soon? Yeah. Will the surviving spouse be okay? What about if you need long-term care? You get sick along the way. Is the surviving spouse going to be okay? What about all these things? Their response was, Mike, that's why we're here. All he talks about is investing. And we're starting to realize, we're suspecting that there's more to retirement than just how we invest money. And we really want a second opinion here to see if, are we really doing the right thing? Do we need to change advisors? What should we really be doing here? We said there are 3 things we got to get right. And if you think about it, it's your money, your taxes, and your risk. You got to get your money right, which means, yes, you have to have an investment plan, obviously, but you also have to have an income plan. When are you going to take Social Security? If you have a pension, when are you going to take your pension? Should you take the lump sum benefit if it's available, or should you take the traditional payment plan? What about, do you have deferred comp? Do you have rental income? Are you going to work part-time? Are you going to have a consulting business? A lot of different factors come into play as to when, how you're going to structure your income. Because when you retire, you need to replace your paycheck. You need a paycheck replacement plan, right, is how I like to say it.
Yep.
So you got to get your money right, investing in income. What else do you have to get right? Taxes. This couple that came in the office, they had over $1 million in their retirement plans, their 401ks and their IRAs. That's going to generate a lot of taxes. The IRS is going to want an increasingly large share of that over time. So, what is your plan? You're probably not too different from them. You probably have a lot of money in your 401k, your IRAs, or 403b. What's your plan? How are you going to keep more of that money in your pocket versus giving it to the IRS? And then, of course, risk management. I think of 3 things with risk management. One is, what if the market goes sideways for several years? 2, what if inflation goes crazy? We've seen that lately.
Yep.
And 3, what about your health? We all want to live a long, happy, healthy life, but what if you get sick along the way? What if you die too soon? Is your surviving spouse, if you're married, that you leave behind, will that person be in good shape? So these are the things that we need to think about. So let's dive into the first one, which is income. So here we've got this couple coming in. And let's say they had an even $1 million. They had a little bit more than that, but let's say it was even $1 million.
Yeah, just to keep it simple.
Yep. And as you're listening, you might have more than that. You might have less than that. And that's okay. Just listen to the concept here. So as we went through our conversation, they said, they needed the classic 4%, right? 4%. They wanted that portfolio to generate $40,000 a year.
Okay.
And I said, okay, great. $1 million, you want $40,000 a year. Well, how much does your portfolio generate for income now? Guess what their answer was?
Like $12,000.
They had no idea.
They had no idea.
We don't know.
Yeah.
Yeah, and guess what? Most people don't know.
Yeah.
Right? So we said, all right, well, let's figure it out. So they had their statements with them, and we put it in our system, like our analysis system. And it told us, oh, look, on your $1 million, you are getting $15,000 a year of income. And how much did they want?
They want 40.
They want 40,000. So we're thinking, oh, we're a little short. You want 40, you got 15. But it was worse than that. Because their advisor, did their advisor work for free?
Oh, absolutely not.
No, their advisor was charging them an annual fee, a fee that was pretty standard kind of across the industry. They were charging them 1%. What's 1% of $1 million?
Well, it's a pretty good chunk of that portfolio.
$10,000, right? So the portfolio was generating $15,000. So let's go back to where we were. Let's start at the beginning. They wanted, how much did they want? What was the goal?
$40,000.
$40,000 of income. But their portfolio, like a lot of portfolios today, because interest rates are low, was only generating 15. So they want 40, they're getting 15. But the 15 that they're getting in income, 10,000 of that's going where?
To the advisor.
To the advisor. So what do they have left?
5.
There's
an even bigger gap now.
5,000. So they're short $35,000. So I asked them, I said, okay. And I kind of know the answer because they didn't even know how much your portfolio was generating for income. But I said, look, how do you think your advisor is going to generate the other $35,000? I mean, they're not getting income and dividends, interest and dividends. So where's the other $35,000 going to come from? How are they going to get that? What does that other advisor have to do to get the other $35,000?
You got to start selling shares.
You got to sell shares. Now, if the market is up, is that a problem?
No, that's great. No worries at all.
Yeah, because what do we want to do? We buy low, but when do we sell? We sell
high. Yeah.
Sell high. What if we're in a bad market environment?
Well, that's a problem.
Because then we would have to sell what?
Low.
We don't want to sell low. That's how we run out of money. So this is kind of like this little example. Let's imagine that their $1 million, so they had $1 million portfolio. Let's imagine it was comprised of 100 apartments that were each worth $10,000 each.
Okay.
So 100 apartments, $10,000 each, that's $1 million.
Okay.
And their apartment complex, that complex, a 100-unit complex, it generates rental income of, what did we say, $15,000.
Yeah.
Right? Ugh, right, for the year.
Yeah.
But they got to pay a management company $10,000. So their net income's like $5,000. Mm-hmm. And by the way, anyone who's in the real estate industry would say that's a crummy deal, right? You got $1 million of property and you're netting $5,000. Ugh, you are a crummy real estate owner.
All the real estate people are picking up the phone right now.
Yeah, they're like, you guys are idiots, right? But that's kind of what it's like. So if that were you own 100 rental units each, and you get 5,000 net, but you need 40. How do you make up the 35,000? You have to do what?
Got to sell the apartments.
You got to start selling apartments.
Yeah.
You started with 100. You got to sell like 3 or 4 apartments. Well, now you're down to 96.
Mm-hmm.
What happens next year?
Got to sell a few more.
Yeah, because next year, guess what? Your rents, hopefully they're going up.
Yeah.
But if they're not, now our gap is bigger. We got to sell more. And next year we got to sell more. And we got to sell more. And we got to sell more. What happens is eventually we run out of money. So one of the big challenges. You talk about this. An investment plan is not
a retirement plan.
Okay, the big challenge that this couple, Bob and Susie, had was this. They had no income plan. They had no way to, they had no clear way to get the $40,000 a year from their $1 million that they wanted, other than, let's just hope the market goes up every year and we'll sell shares.
Yep.
Right? That's not a plan. That's hope. Okay. Hope is not a plan. A plan is, we're going to structure the portfolio in such a way that you get that $40,000 every year, no matter what the market does. It shouldn't matter what the market does. It should not matter. And there are ways to do that. But this couple, there were no conversations there. So what about you? What about you? Are you looking to retire soon? How are you going to generate income from your portfolio? Is your advisor laid out for you a clear path to generating that income no matter what the market does, good or bad? They got over $1 million in their 401k. And so one of the things that we did in our software planning, it helps us map out in a very clear way, here's how long your money's going to last at different rates of return. But also, here's what your tax obligations are likely going to look like in the future. So this is an area that I think very few financial advisors spend time on because, of course, they don't get paid to do it, so they don't care, right? But I believe, I've learned over the years, it is really important to know the tax path that you're currently on. It's really important to have that mapped out. So, every advisor out there, they say, oh, look, your money's going to last. Yeah, yay. But what they ignore a lot of times is they don't show you, here are the taxes that you're projected to pay year in and year out over your retirement time horizon. And then you add it all up, like, what does that look like? So in any event, with Bob and Susie, that's what we did. I showed them, I said, look, if you retire next year, and they wanted I think it was $85,000 of income after taxes, about $7,000 a month.
Yeah.
They had everything paid for. They had no mortgage on their home, no car loans. They owed nothing. So, and they kind of lived a normal life in between. Their biggest bill, I think, was their property tax and their insurance. But outside of that, it's we really don't spend a lot, right? So they wanted $7,000 a month. And so $85,000 what they wanted is we kind of went through it. We said, okay, what does the tax bill look like for you in the first year? And it was $6,000 or something, as I recall.
Not a big deal.
Yeah. And I said, okay, so let me ask you the question. You've got $85,000 that you can spend, right? You're going to have to give $6,000 to the IRS. That means you really got to bring in whatever that is, $94,000 or $91,000. Sorry, my math is off. You got to bring in $91,000, $6,000 goes to the IRS, $85,000 goes to you. How do you feel about that? Do you have a tax problem?
No, not right now. I don't think so.
They don't. Yeah. Not early on. I mean, gosh, what is that? 6 or 7% tax rates effective? Yeah, they have no tax problem then. And then we went down the road. We said, well, what about when you're 70? What do your taxes look like now? And, they needed more income because of inflation. And again, though, their tax bracket was still about 8 or 9% effective. So again, no big deal.
Yep.
But then a magic thing happened 2 years later when they were 72. We said, well, what happens when you're 72? Something magic happened in that year.
Ooh, the required minimum distribution year.
Yes. Suddenly, they're forced to take required distributions. And in their case, that $1 million had been sitting there and it had been growing because they had other money outside of that, right? That $1 million has been just sitting there growing for several years. And now their required distribution was like 60, 70 grand the first year. 60 to 70,000 of money that they did not need at that point. But it doesn't matter. They got to pull it out, and they had to pull it out. Guess what? They got to pay.
Got to pay the tax.
They get paid tax on it. But here's the thing. It's not just tax on the money they pulled out. They also have to pay more tax on their Social Security. They got to pay more tax on their capital gains. They got to pay more tax on everything else. So they get double whammied. And that's when their tax liability suddenly jumped to a rate of a net rate from, they were at like maybe 8%, it like doubled to like 16. Do they have a tax problem now?
Starting to kind of, get up on one.
Starting to look at one, right?
Yeah.
And so we fast forward. What about when you're 75? What about when you're 80? What about when you're 85? We just start forwarding saying, look, this is the road you're on. This is where you're going. Like in this couple's case, by the time they were 85, they're paying like $32,000 of tax. And remember, they started out just saying, we just want $85,000 to live on. Now they're paying $32,000 of tax. And then the husband dies at 85, leaving the surviving spouse as a single taxpayer. And what would her tax bill look like?
It's going to be even higher.
Yeah, it was like $40,000. And it's like, we start out in retirement, and we're like, yeah, our taxes not big tax problem. But the further we go, the worse it gets, and the worse it gets, and the worse it gets, and the worse it gets. It just gets worse and worse and worse. The IRS just wants more and more and more, and it gets horrible. And that all assumes that tax rates do not go up, which is a very silly assumption, right? So the question I asked was, have you ever seen anything like this? It shows you where you're going from a tax perspective. Like, this is a tax road you're on. Has anyone showed that to you, like, ever? And their response was, no. This is the first time we've ever seen something like this. And they had worked with a financial advisor for the last 15 plus years. And, oh, by the way, they also had a CPA who did their taxes. He'd been doing their taxes. She had been doing their taxes for the past 10 plus years. And neither one of them have ever bothered to show this couple that information. I said, how do we feel about that? They said, well, early on it's good, but we don't like where this is going. I said, guess what? I don't like it either. Would it make sense to maybe look at doing some tax planning today that could avoid all these taxes later on? Well, what do you mean? Well, what if we did some Roth conversions today to avoid a bunch of tax later on? Well, gosh, Mike, what might that look like? And so using our system, I just plugged in some different ideas. And we learned really quickly that we didn't even have to do these huge Roth conversions, right? Even just a series of smaller Roth conversions, they had to pay a little bit more tax today, but oh my goodness, it saves so much tax later on. Instead of the surviving spouse paying $40,000 of tax, she was paying like $3,000, right? Instead of paying $32,000 or $33,000 of tax when they're in their 80s, they're paying maybe $2,500.
It's a big change.
I mean, it's just huge what the changes can be. But you can only make those changes if you first know where you are now. How can you fix a problem that you don't know you have? Because here's the thing. You can make all the right choices with your money. You can make all the right choices with your taxes. But there are some things that can happen out there in the world that can throw you for a loop that you don't control.
The unexpected.
So you need to think about, how are you going to structure your planning to protect you from that? They might be market related. They might be inflation related or economy related, or they might be healthcare related. So I went to this couple. I said, okay, based on what we're seeing, Bob, Susie, based on what we're seeing here, as long as you can get a 5% return, I guess, I think we wanted to assume conservatively, you get a 5% return, your money should last for your lifetime. Now let's take a look at some different risks out there to see if it could cause some problems. So over the last, from 2000 to 2009, that was a 10-year period. The stock market earned essentially nothing. In fact, it lost money over a 10-year period. From 1970 to 1979, same thing. The market basically was flat over a 10-year period. The market does that from time to time. You will have, over time we know it goes up, 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 right? But there are periods where it kind of takes a rest. It's kind of like a race car. You can't sit there and go whipping around the track forever. You got to take pit stops, and the markets take 10-year pit stops from time to time. So the first question, and our software helps show them this, we said, Bob, Susie, your money should last to your 100, but what if? What if the market decides it's time to pull over and take a pit stop for the next 10 years and just kind of be flat for the next 10 years? How would that affect the ability of your money to last, given how you're structured today? And we learned, they would run out of money when they're 87 years old. And by the way, Bob's like, oh, it's not a problem for me because I figure I'll be dead by then. But Susie here, her mom is 95 and still kicking, so that's probably a problem for her.
Yeah.
Right? I said, are you okay with that? No, we are not okay with that, right? Okay, that's something we need to maybe work on. How about this risk? What about the economy? What if, inflation has been nothing for the past 30 years, right? What if inflation suddenly starts going crazy again, like it has recently? What if inflation, instead of being 2 or 3%, is suddenly 4 or 5%? Plug that in the system. Oh boy, guess what? Now money's running out at age 85. Well, what if you get both? The market goes goes sideways for several years and you have inflation. Well, now their money's running out when they're like 82 and they're starting to freak out a little bit.
Yeah.
And do we control what the market does?
Nope.
Do we control what inflation does?
Nope.
Well, we think we're going to live a long, healthy life. Bob, what if you die early? Because it would never be politically correct to pick on Susie dying early, right?
Can never do that.
We'll pick on Bob.
Yeah.
It's more, and us men.
Sorry to all Bobs out there.
Sorry to Bobs.
Yeah.
Yeah, Bob, what if you die early? Is Susie going to be okay? What if you don't die, but instead you get sick and you need some kind of long-term care for a few years? Will Susie be okay? Again, both scenarios. No, Susie is not okay. And then you start stacking them together. Well, what if the market goes sideways and we get inflation and you get sick along the way or somebody dies along the way? You start stacking these together. It's like, guess what? Congratulations. Your money's going to last to age 100. Your retirement's all set. As long as all this other stuff doesn't happen, as long as the world turns in a perfect rotation for the rest of your life. But if something wrong happens, Bob, Susie, you're in trouble. What's your current advisor telling you to do here?
I don't know.
Current advisor never even talked to him about it.
Yeah.
Right? They never even talked to him about it. See, here's the deal. What do we say? An investment plan is not
a retirement plan.
And if you can't tell that crystal clear by right now, it's like, look, you got to deal with income planning. You got to deal with tax planning. You have to deal with these different risks out there. How do you address those risks? Now, the good news is, by the way, can I sit here and guarantee Bob and Susie they're going to be set for the rest of their lives? I can't do that because I don't control all these unknowns. Can I help them plan, though, to mitigate the effects of those risks happening? That we can do.
Yep.
But you can only do it if you first do what? Talk about it, explore it, analyze it. The challenge is very few financial advisors do that. So here we are. We're coming up to the end of the show, right? And here's the deal. We have a special offer this week. First 10 callers, we're going to absolutely free give you a second opinion, just like I did for Bob and Susie. I can do it. We'll do it for you. It's a busy time of year, but we said, what the heck? Let's carve out 10 spots. And, it's free. It's no obligation, right? What we'll do, you call in, we will give you absolutely for free a complete 360-degree second opinion on your planning. You can't get a second opinion from the person that gave you the first. Why not get a second opinion from someone who has done this for 20 plus years, that is really focused on this time of life when you are getting ready to retire, when you get into retirement? If you're recently retired, if you're retiring soon, this is for you. And it's free. But here's the deal. We started with 10 spots. How many do we have left, Zach?
There's like 2 left.
We got like 2 left. So here's what I'm going to do. You got to call now. And you know what, Zach? I don't know how I'm going to do this. This is going to be your problem, not my problem. I'm going to be nice enough. I'll even open up one more. So we'll say you got 3 spots left. First 3 callers, they're yours. But the deal is, now listen, here's the deal. You have to have saved at least $500,000 for your retirement. So as long as you saved at least $500,000, you want to call now. There's only 3 spots left. Let's make sure you get your retirement planning ducks in a row. Zach, what's the number to call? It's after hours. You get our answering service. They'll set you up with a phone call with either myself or the team. What's the phone number?
Mike, it's easy. It's 512-886-5850. Again, one last time tonight. It's 512-886-5850.
All right, gang. You heard the number. 512-886-5850. Call it now. Let's get your retirement planning ducks in a row. You will be glad you did. And if you miss out, well, you're not going to be happy you missed out. So just call now. All right, that's our show. See you next week.